joins us now. Brad, thanks very much indeed for joining us.
Thank you, Andrew.
The consensus seems to be we won't get an actual interest rate change from the Fed today.
No, I think there's too much uncertainty around inflation and the effect of tariffs and the new Trump policies. So I think they'll be on hold and they'll give the same guidance that they're watchful for either weakening unemployment picture or accelerating inflation. They feel like they're in a good place to move either way.
What is your take on the U.S. economy? Do you think, I mean, we don't know how brutal this tariff war will get, but do you think economic growth is going to be jeopardized?
I think there's no doubt that things are slowing down. So you can look at the Atlanta Fed Now GDP forecaster. It's slipped into negative due to an export anomaly, but it's definitely decreased. Earnings expectations for this year have come down from 13-ish to between 8 and 10, and then there are sort of straws in the wind, like the airlines announcement last week, Delta and United and American, about a reluctance among leisure travelers in the U.S. So clearly we are seeing a slowdown. We don't think it's going to be we're falling off a cliff, but given the expectations coming in, it's just an adjustment for markets.
You and many other investors are taking a fresh look at Europe. Are you moving some of your portfolio weighting into that part of the world?
Well, we were already positioned in Europe because of the valuations, which we viewed as absurdly undervalued. So going into the year, the U.S. was trading on 22 times forward earnings, and Europe was on something like 14. Wow. And we think that gap has a long way to run. So, by the way, you say a lot of people are moving in that direction. I think that's true. That Goldman did a survey of their clients in January at their London conference, and they asked everybody which markets would perform best in 2025. 58% said the U.S., 8% said Europe. So there are a lot of people who are offsides and lagging an ACWI benchmark, and they need to get onside. And so I think that and the positioning and the valuation gap can make this run a long way from here. There's a tendency to think you've made 20% relative, and so you should go to neutral or go to the sidelines. I think there's just a long way here.
That's interesting, a long way to go. Do you have a preference among European markets?
Not really. We like global players like Novo in Denmark, Roche, Novartis in Switzerland, but those aren't really Danish or Swiss stocks. We like Schneider in France. We like the luxury goods players, LVMH and Hermes in France. But again, those aren't really tied to any country. They're just global companies with extremely strong market positions. So for preference, we like a little bit of the large cap defensive growth names relative to the cyclicals and industrials that have had a big run recently on the German stimulus. That may be pushed a little too far, and we think the defensives have been left behind. So at the margin, we're buying safer growth stocks in Europe.
We talk about the Mag 7 as if they were a cohesive group, but of course they're very different companies. But in general, you have been underweight the Mag 7 names?
Yes, and in the latest drawdown, we've started to close that underweight, meaning, NVIDIA, when it was trading on 40 times earnings, was a little bit stretched. We thought the expectations were too high. On 23 times earnings, the Mag 7 are now, as a group, in the sort of mid-20s, 25, 26 times earnings. That premium to the market is a lot less than it was. They used to be a 50% premium to the market. They're now more like 25%. So they're coming into the range of interesting, and we've closed our underweight as a result, but we still stay underweight the Mag 7.
I think we're going to have to leave it there. Brad, thank you very much indeed for joining us. Really
appreciate it.
Thank you.
Enjoyed it. Take care.
Brad Conger, our Chief Investment